Hello,
Good
everyone.
morning, everyone.
Oh, hey, go for it, Robin.
Good morning, everyone. She's trying to take my job. Thank you so much for joining us today. We're going to give people, it's only 11, it's 11:59 or 12:59 on the East Coast, so we'll give them a minute or two to join in. I can see people are coming in. In the meantime, I will drop some comments in the chat, but if you have any questions at any point, please feel free to type them in or send me an email, robin@strategyleaders.com, and I will be happy to have Andy answer them later in our presentation.
So let me know when you're ready to go, Robin.
Let's give them one more minute and then we can get started.
Okay. Fair enough.
All right, I think we can jump in.
Okay, great. So welcome everyone today to figuring out if you're getting paid what you're worth. This is a really important topic for business owners, and I hope that it gives you data that you need and a way to do a reality check for yourself and your company. And while we're waiting for people to join, I'm going to take a couple of minutes and do some welcome and introduction. This webinar today is being brought to you by Strategy Leaders, and Strategy Leaders was based on research done at Columbia University. The company has been around for 30 years. We have a skilled team of specialists who are working on the growth and development of privately held owner-operated businesses with experience in tons of industries. It's just amazing to me how many different ways people go to work to make money. We do have a nationwide footprint, north to south, east to west, and we offer a broad set of services, which I will get into here in just a second. In terms of ways that we can help, I would encourage everyone here, call us for a free consultation, explore the possibilities. You do see here on the screen a QR code. That's a booking link. So, whoops, sorry. That's a booking link, and please feel free to use it. And we'd love to talk with you about what you're thinking about doing with your business. In terms of ways that we can help, salary benchmarking, financial dashboards, accurate forecasting, really getting business owners a handle on what's going on, developing key performance indicators for the company, for individuals, or for the divisions or departments. We also, in terms of today's conversation, this will come into play a little bit. We do business valuations and what if modeling. And then we also can help business owners with their buying or selling game plan. So those are a bit of the products that we work on. In terms of services, over on the right, we work on management team development, executive coaching, buy-sell advisory. It's actually worth noting that the brokerage services that list websites for sale, they will actually report that something like 90% of the deals that get started never cross the finish line. And that's where we come in, is making sure that the finish line becomes a reality, whether you're trying to buy a company or you're looking to sell your company. We also do next generation training and development, business growth planning, and working on actual crafting of business plans to guide the development of the business, and accountability training, whether that's for the company overall, for individuals, or for departments. And with that, let's get started with today's
Hey,
webinar.
Andy, do you want to pop back into full screen mode?
Hold on. Sure. Second here. There you go. Sorry,
There we
I
go.
hit the wrong button before. So, in terms of today's webinar, if you had to hire someone tomorrow to run your business, what would you have to pay them? That's a critical question to ask, not only because it's a possibility that could come into play, but also because you need to be thinking about, are you actually being compensated as if you were that executive who is running the company, which for the most part you are. Um, I will tell you that most business owners are paying themselves wrong. We see this in virtually every situation that we step into. Some people are taking too little. Some people are taking it all in draws. We're going to get into the problems around that. Some don't leave enough money on the company so that the company can grow and prosper over time. And some companies just don't make enough to be able to pay anybody what they should be making. And we're going to dig into all of these issues. In terms of some data here, benchmarking owner pay, this is 2025 data. Small business owners, in terms of salary, are taking typically in a range of 75 to 130,000 a year, and that's with higher risk because they're actually putting the chips on the table and they're acting as the financial backstop for the company. And the average of small business owner pay in the United States is around 73,000. So at the low end of that owner range. CEO salary, so individuals who are not risking it, they're hired help, it tends to average around 86 to 341. So when you're hiring a CEO, they're getting paid at a higher rate with an average of 192. And then if you go into public companies, they're talking about compensation that it gets up into the millions because they're now actually getting shares and leveraging off of the growth and development of that publicly held company, which is way beyond what most small business owners ever realize. Now, net owners are getting shortchanged, and these aren't rules, they're data points, but the pay should reflect your value. And that's a company's value as well as an individual values. So why do so many business owners underpay themselves? There's a lot of issues, and I hear this, all of these issues and many more from business owners that I talk to. I can't afford to pay myself what I'm worth. It's a badge of honor. I don't want to take a paycheck. I'm here to grow it for the long term, and I'll get my value at the end of the game when I sell it. There's cash flow fear. I might not have enough money to pay me if I take money out. It might hurt the company, or I don't want my employees thinking I'm greedy. That one is really crazy behavior. Um, and there are also some operational traps that get in the way of getting paid what people should be paid. Inconsistent cash flow is a big issue. The owner ends up taking ad hoc draws and gets paid last and gets paid least. There aren't any industry benchmarks, so you saw the numbers on the previous screen bouncing all over the place. As we looked at that data, every different reporting system had a different set of data. It's all over the place. There are some sources you can go to, but there's no target in the company and there's no planning in the company to actually get the amount that they want to pay on the books. There also is an issue of blurred personal and business finances, which leads to confusion and issues at tax time. Probably the most egregious one I've heard is a business owner at a conference proudly stating that his kid's college tuition was paid out of the company's coffers. Now, I'm going to assume his accountant caught that at tax time and adjusted it out of the expenses of the company, but that sure leads to a lot of confusion as to what the company's net income is and what the owner's compensation is and should be, and then real issues in terms of taxes. And then finally, they're just unclear compensation rules. How do people get paid? For what purposes? And that happens a lot in entrepreneurial companies, both at the owner level and at the employee level. So let's just talk about the cost of underpaying yourself. The first one that I run into, I'm dealing with this now with a client, is burnout, chasing a dream without facing reality. So the owner is really frustrated. They came to us the beginning of this year because the company hit a tough spot last year. The owner took a massive pay cut and couldn't figure out how to get the company back on track. And because of that, the owner came to us and said, look, I don't even really think I want to be here anymore. It's just not worth it. Well, we've worked over the last 6 to 9 months. We've got them back on track. And the owner is now saying, hey, this is back to being a pretty nice company. I'm getting paid for what I want to make and need to make. And I'm ready to hang out and continue working on this. Another issue is personal risk. I see a lot of business owners who end up with no savings or little savings and little or no retirement. There's a buyer perception that the company is undervaluing its leadership, which then impacts how that buyer values the company and what they're willing to pay to acquire the company. So that's at the time that you're selling. That there's also a sale outcome in terms of a lower valuation. So when you get a valuation done, the owner compensation is added back to net income. And if you're not reporting any compensation to the owner or limited compensation to the owner, the net income is going to be lower, which then lowers your valuation. There's also an issue of IRS scrutiny. So the IRS is looking, particularly in S corps, is where this happens. They're looking at unreasonably low salaries, and then there's also confusion about compensation versus tax payments. So, for example, the company may be paying the owner 300, let's say 500,000 a year. 350 of that is actually going to pay taxes on profits, and the remaining 150 is what the owner gets. But the owners are looking at it and thinking, oh, I'm getting 500,000 a year, and the employees look at it and go, wow, that guy's making a lot of money, or that woman's making a lot of money. Well, in reality, that's just being passed over to the owner of an S corp to make the tax payments, because that's how the tax laws work. So that is a lot of confusion. When you look at salaries versus distributions versus taxes, you got to keep in mind you wear two hats. So we're starting to move towards understanding the foundations for the solutions, and we'll start getting to the solutions very quickly, I promise. You do wear two hats as an employee and as an owner. So as an employee, you're in an S corp, a C corp, and an LLCs that are designated as either S or C corps. You get a salary and you may get a bonus, and that's your pay for your job as CEO, and that comes to you in a W-2. Then, in addition to that, you get paid as an owner shareholder. That happens in LLCs, in S corps, and also can happen in C corps. And the distributions become return on ownership, a share of profits, and there's a tax payment in the case of the S corps and the LLCs, which I touched on a couple minutes ago. So both or all of these sequences matter. Don't confuse one or the other. And this is where your accountant comes in and should be giving you a good advice. But we also work on this a lot with our clients. So IRS perspective, just for information here, looking at salaries versus distribution, the reasonable salary rule especially comes into S corps or LLCs that are designated as S corps. The IRS requires a market rate W-2 salary for active owners. The distributions can't replace all the wages, and you've got to keep in mind that Social Security wants its cut. So right now for 2025, Social Security is deducted on salaries up to 176,000. So if you're giving yourself a low paycheck and a big distribution, the salary is not withholding enough for Social Security to be satisfied, and any non-compliance is going to get you audit risk, penalties, and confusion about who got what and what the owner really made, as I said before. So how salary fits into business economics. think about it as pieces of a pie. Gross profit, you really want to see your gross profit be 60% or better. Your salaries range from 10 to 35% of revenue. Your net profit should be in the 10 to 20% or better range. And this is of revenue. And you can pay yourself fairly if your margins are healthy. I would not use these numbers as drivers in your decision-making process. It's just give you some perspective. So the one thing you want to keep in mind is that the P&L is an incomplete picture of reality. The net income on the P&L still has to cover a lot of things. There's debt, which is paying down principal. CapEx, which is investment in the future, whether that's typically in a manufacturing company, it might be equipment. In a service company, it might be investment in additional salaries and services. Then there's taxes on the net income. There's working capital, which is the reserve funds for the business. And keep in mind, most businesses do not have enough reserve funds. You typically want to have at least 6 to 12 months of working capital, overhead capital in reserve. That sounds like a lot of money, but for all of us who went through COVID, we found out that that number was basic minimum to keep going. And then finally, there's shareholder distributions. So if you keep this in mind, here's an example of what drains net income. Let's say the company had 200,000 of net income. The taxes, federal, state at 35% were 70,000. The principal payments, this is a decision by the owners. Let's say they had some COVID payments and they want to pay down the idle loans that they got. So they're making 4,000 a month in COVID payments. And then CapEx, they want to add tools to grow. And then they want to add to cash reserves. So that'll sit inside the company, but you still have to set the money aside to do it. And once you deduct all those numbers from net income, you have $5,000 left for shareholder distributions. And this is where I see a lot of business owners getting themselves into trouble. They look at that net income on the P&L, they go, Yahoo, I can take some money out of the company. They take their share out, whatever they want, and then that ends up impacting every one of these numbers, except for taxes, which the government is not going to let you fudge on. So there are 3 buckets of pay. Salaries, which is the W-2 income. Distributions, which are the periodic profit draws. They could be monthly, they could be quarterly, they could be annually. And then there's retained earnings, which is the share value increases as long as you don't take all the money out of the company. And in a healthy business, I want to make the point that a healthy business can get all 3 of these done. So some of this is a discussion also about how healthy your company is. When you're trying to diagnose rules, the first place you want to go is you want to go look at the company. So where are things off track if you're having trouble hitting the compensation that you want? So first of all, do you understand what's fair compensation, both for yourself and for the rest of your employees? If you have any questions about that, we can actually help you benchmark that and develop min and max ranges for all of the positions in your company based on your geography, based on your company type, based on your size. Then do you have enough of the right revenue? So client that we're working on right now, as they went through the analysis of this with us, they found that they had a bunch of clients that they were making big revenue on, but very, very, very little profit. They were working really hard for not a lot of benefit. And as they started to shift that around, things got easier for the company, more profitable, and they had more left over for owner compensation. The next question, is your cost of goods sold accurate? We see this all the time, that owners do not have a good picture of what goes into cost of goods sold. And if you don't understand what it costs to deliver your product, you then can't figure out how good your gross profit margin is and what you have left over for overhead. So is your gross profit margin sufficient? We started out with a company that we thought we knew what gross profit was, and once we finished digging into it, there were another 20 percentage points pulling out of the gross profit margin that was buried in overhead. So we had to change and fix that. That changed the picture of the company in terms of where their break even was, how much money they were making, and how much they had to invest in the future. Then do you have good control over overhead? Is it constant? And is it limited growth in overhead year after year? You should be growing your overhead 3 to 5% a year, marketing costs 5 to 7 to 10% a year, and salaries and benefits, again, should be benchmarked at the 3 to 5% range. Then do you have sufficient net income? So is this working? Is it producing a net income? And if there is net income, then do you have that balance sheet plan in place? What you're going to spend on shareholders, debts, and cash and taxes. So let's talk about shifting the mindset of the owner. You want to ensure that you can reward leadership as you build a sustainable company. And to do that, you've got to ask some critical questions. Can the company afford to pay you and your employees what you're worth? Are you paying market wages? Can you afford to hire the talent you're going to need in the future to grow the business? So do you have a good forecast and an understanding of what has to change in order to accomplish that? Can the business operate sustainably? Historically and going forward? Again, that's where the modeling comes in. And then what do you do about any gaps? That's the $64,000 question, which is all about both strategy and tactics. Now, if you're looking to get yourself paid what you're worth, here's some steps you want to go through. And it's actually 6 steps. We added one yesterday. So you want to benchmark your role against peers and then set a consistent market-aligned W-2 salary. You want to separate salary from profit distribution. Then the next step is to confirm that employee wages are at market rate. Then model the cash flow to ensure sustainability. And then finally, and here's the step we added, is review annually as the business grows. So salaries are not static, and neither should your calculations be. This is something you need to review and update annually. Now, in terms of looking at the impact to evaluation, I touched on this before, I'll get into a little more detail here. So if you pay people well, you're going to build value for tomorrow. The buyers will adjust for normalized owner pay. So let's say you're paying yourself that minimum number of $73,000, but in a company like yours, the CEO should be making $200,000. The buyer is going to come in that and evaluate that and figure that out. They're going to do their homework, and they're going to then adjust the valuation downwards to account for that gap of an additional $125,000 that it's going to cost that you don't have in your expenses right now. I will say that paying appropriately does build EBITDA because it provides profitability and sustainability and raises the sale price. So again, if you're paying market wages, that's going to reflect in driving the profit forward because you're actually working on a formula to understand how people should be paid and then working that into the revenue and profits the company has to come up with. Paying yourself and your employees properly now also gets you the talent you need to run the business. So this is a way to get the monkey off your back. So many owners that I talk to say, there's too much on my shoulders. It keeps landing on my plate. And getting employees who are appropriate for the business, have the talent they need, and are paid appropriately, and so that you can afford them and run the business. You're going to build long-term value for the future. That's going to encourage you to keep going. So back to that story that I told you a little bit ago about the business owner who said, I don't want to be here. And 6 to 9 months later says, hey, we're back to this is a pretty nice company. Let's keep going. That is how you strengthen the business. Now, here's a 30-day compensation checkup. Why 30 days? You could do this in 60, you could do it in 15, but we like to give you a 30-day plan. So step one is know what you actually take home, pull your year-to-date financials, total up all the money you've taken all into the business in salaries, draws, and perks, divide that by total revenue to look at the percent that's going to owner comp. That's a data point. And then healthy owner pay, again, look at that 10 to 35% of revenue, but recognize that really depends on the industry, the margins, a lot of factors that will influence that. So once you've got that data, then you want to benchmark your value. So research what a CEO earns in your industry, for your geography, for your company size. So there's a bunch of caveats. I don't want to compare someone who is located in California with somebody who is located in Mississippi, for example. It has to be a geographic specific. I don't want to compare someone who's running $1 million company with someone who's running a $10 million company. I also don't want to compare somebody who's wholesaling with somebody who's manufacturing. So this research has to be very, very specific and targeted. Then you want to benchmark all your other employees as well as yourself, same parameters of industry, geography, company size, etc. And as the note says there, we can help you with that. We have the databases to help you get that data done. Then ask yourself, if I had to hire someone to replace me or anyone else in the company, what would it cost? Could I get it done? And then use that as your market rate target. Use your baseline for what you should be paying in W-2 compensation, which would be both salary and bonus. Now, number 3, structure your pay the right way. So now set a consistent W-2 salary, and your paycheck for leading the company, your employees' paychecks for doing the jobs that they're assigned to do. You also then want to take profit distributions as additional return on ownership, but that's not instead of salary. That's in addition to salary. You want to leave room for retained earnings to fund taxes, debt, and reinvestment, and then salary, which is pay for the work that you're doing, distributions, that's the reward for ownership. Step 4, stress test the cash flow. So now you know what you want to be paying in both W-2 and additional earnings coming out of profits. Now you're going to stress test the company. Model your salary as a fixed monthly expense, then do the same thing for employees. Determine what it will take to build up 6 to 12 months of operating cash reserves. Figure out what taxes you're going to have to pay, figure out what principal you have to pay, and if there's any shortfall, identify what needs to change. Revenue, which would be volume, pricing, or client mix, the margin, which is the cost to produce and deliver, the overhead control, or the debt leverage. And figure out what's going to have to change and then build a plan to do it. And then step 5, have a game plan to review and adjust regularly. You're going to reassess your compensation every quarter, and as revenue and profitability grow, you should think about increasing your pay as well, probably through distributions until you get to the next annual mark. Keep your business and personal finances separate and consistently build your valuation credibility by doing that, and then have a plan to ensure that employee wages keep up with the market. So here's a process to work through. There's a lot going on here. We'd love to help you work your way through this. So recap and takeaways. Salary is your pay for leading. Distributions is your reward for ownership. The net income does not equal free cash. It's got to go to a bunch of things like taxes, profit distributions, pay down loans, and build up reserves. Make sure you're using facts to ensure that you and your employees are paid appropriately. I find a lot of times that when we do compensation studies, we find some employees are underpaid and some employees are paid just right. What you then have to do is build a plan to get everybody to the just right level. And that plan to get it to come what you ultimately want to have in writing to help guide you in what you're going to have to do over the next weeks, months, and years to get things on track. So your next step, our suggestion would be figure out where you are, where you want to go, book a free strategy session with us, no pressure, just clarity, talk about it, talk it through with us. Happy to do that. We'd love to help you get a better picture on where you are, and then talk about whether or not you need some help to do that. And with that, there's lots of ways that we can help in terms of brainstorming, figuring out, assessing, training and coaching, preparing people to lead, assisting with ownership opportunities, building thriving companies that are run by confident owners and managers, and creating wealth for our clients. That's what we're all about. This is what we do day in and day out for our clients. And with that, we're at the half-hour mark, and we have plenty of time to take questions. Drop your requests and email in the chat window, or shoot us an email if you have questions. Book an intro call. Use this QR code to book an intro call if you want to chat. And then also, if you burn out, so does your business. This is on Wednesday, November 5th. Robin's actually going to be taking this webinar. And I think this comment here, 87.7% of entrepreneurs report struggling with stress, anxiety, and burnout. This is something that's costing them growth, and most SMB owners are making sure that they're measuring profit, revenue, leads, but never measuring themselves and what they should be getting. And so you want to sign up for this webinar. If today's webinar was useful to you, this one will be even more so. And with that, let's take some questions. So Robin, do you have some
Great.
questions?
We do have a couple questions. I got them in through email. So, okay. What's the best way to transition from taking draws to paying myself a regular salary?
Okay, so as we look at that, the first thing that we'll talk about is, are you actually doing any withholding on your draws now? So your accountant should be making adjustments, and it's a question as to whether that money for taxes and Social Security is being withheld on your behalf, either from the company or out of your personal income. You need to know where it's coming from now. Once you figure that out, then you can create a paycheck for yourself. Your company is already, if you have employees, on a schedule, whether it's weekly, every 2 weeks, or once a month, and you're going to follow the same schedule as they do. And so now you can calculate how much you're going to be paid and either gross it up to allow for Social Security and other withholdings, or you're going to take the gross amount if the company's been paying that stuff on your behalf, and then you'll get the withholdings taken out, and you'll be at the net that you should be at now.
Okay, great. This one's kind of interesting. So, can I adjust my salary during the year if my business has seasonal swings?
So probably not. What I would suggest is a more steady salary, and then bonuses or distributions on a quarterly basis matched to the seasonality of the business. But I also keep in mind that that seasonality may play out different ways in different years. So I'd be careful how much money you're going to take in distributions just because you had one good quarter. Make sure you're putting enough money aside so that the business has reserves to get through the next season.
Okay. Um, are there red flags that a buyer looks at when it comes to owner compensation when we're talking about valuations?
Absolutely. I mean, the first red flag is the owner getting any compensation? And if they are, how does that compare to the market rate if you had to hire someone to replace them? And if the owner's not getting compensation, then the buyer's going to look at two questions. Can the business even afford to pay someone to do the owner's job? And if the owner is overcompensated and the owner hasn't clearly disclosed that compensation, then the buyer may overlook it and the company gets undervalued and the owner seller gets hurt.
Um, this one's kind of interesting. It actually was a situation that came up a couple months ago with one of our friends or clients. Is that I am a owner in a business with my siblings. My parents passed away. The business was left equally to all of us, but I'm the only one that actually works in the business, and I need to take more of a salary. How do I justify that to my siblings?
So first of all, I would take a good hard look at how everybody is paid. And if you have no-show jobs, you need to fix that and get rid of them because it's something that is a big no-no from the federal government and the IRS. So the people who are working in the business should be paid salaries, and anyone who's a shareholder but not working in the business should be paid a distribution as a shareholder, but should not be getting pay because they're not working in the business. So they're not W-2 pay. Now, that may take a little while to straighten out. You may need to adjust distributions upward if the money is there. And you also need to make sure that everybody, that the taxes are being appropriately paid by the company rather than by individuals. So you want to, in an S corp, you get some fluctuations in there. One person owns a house and has a bunch of other deductions and has a lower tax rate than someone else who doesn't have any deductions and has a higher tax basis. And that's not really fair to everybody. So you've got to also work out the tax consequences. And generally what you want to do there is sort through what would be fair and include that money in the distributions. So this is going to take a lot of negotiation, and I would suggest is take a look at your shareholder agreement and how much room you have to operate, and whether as the CEO of the company, I'm assuming you're the CEO or president, whether you can compel decision making or you're at the mercy of the board and the board is governed by your siblings who are shareholders but not working in the business. And it may take some negotiation. We've been in a bunch of those.
Okay, perfect. I have,
Let me just raise
yeah.
one other. So another situation that we have just been through is two siblings, or two partners in the business. One partner is stepping away from the business. Fortunately, they're being grown-ups about it. They have reached the conclusion it's time for one of the partners to leave, and they've negotiated a price for the business. And the partner that's leaving, their salary was about $150,000 a year. Now, it actually was paid in salary because we worked with them a number of years ago to get it shifted from just distributions that nobody could make sense out of to actual salaries for each of the two partners. So we know exactly what that partner who's stepping away is making. And that 150 no longer has to be paid to the partner as a salary. It can be redeployed to pay a loan to buy the partner's shares back. It can go into cash reserves. It can go into other debt repayments. It can be used for a lot of other things. And so you also want to make sure that you have a good handle on how much money am I no longer going to be paying to shareholders who are stepping away, and how else can I redeploy that money?
Great. I have two more questions. The first one is kind of interesting. How do I explain my salary to my employees without sounding greedy?
Ah. Well, my observation is that most employees have already done their own calculations, and they're generally way off on the high side. So the first thing that I would do is I would explain to employees, my salary goes to pay if you're an S corp, or an LLC, my income goes to pay taxes on the company. It goes to pay for me doing a job, and then it goes to reimburse me if I have any shareholder loans that I've put money back into the company. And finally, it goes to pay me a shareholder distribution because I'm doing a good job running the company. The company is worth more, and the company can afford to pay me either a bonus or a distribution for that good work. I want I want my employees to understand the amount of risk that I'm taking as an employee. So I would take the time to say to my employees, look, in lean times, I have loaned money into this company to the tune of X, Y, or Z. And in better times, part of my compensation is getting those loans paid off. That's not free cash that somehow I'm being a pig at the trough. I'm just getting my money back out so I can get back to even. Then I am getting paid a salary, and that salary is benchmarked against the industry for a person doing my job in a similar company and similar geography. And on top of that, as a shareholder, I'm getting rewarded when things go well for the risks that I'm taking as a shareholder.
Perfect. And then the last one is I'm planning on selling or exiting in the next 3 to 5 years. How should I structure my compensation?
Oh, I would absolutely get a benchmark survey done on not just yourself, but yourself and all of your employees. Are we paying market rate wage? And if we are high or low, who's high, who's low? This is something that you can then give to a potential buyer to say, hey, we're actually well situated, assuming that you are. And if not, we have a plan to fix it. Then you get people at market wage, yourself and everyone else. And then you work on a compensation strategy, both for employees. When do people get bonuses? And I would generally tell you that I am a big believer in bonuses come out of profits. They are not a given. You don't promise everybody, I'm going to write you a check for 10 grand at the end of the year. You say there is a pool of money that I'm going to take out of our profits, and I'm going to distribute that pool to people who have really good, solid reviews. And if you're at the bottom of the trough in terms of a review, you may not get a bonus at all.
Okay. Oh, I just got one more in the chat here. Um, they are asking if you could explain what the benchmarking is. You keep talking about the benchmarking.
Sure. So this is actually one of the services that we do provide to clients. And what we do is we go and gather data on all of the employees and what they're paid currently, how they're paid, whether it's hourly, salaried, any bonuses, or any other compensation. We then take their job descriptions and standardize their job descriptions. So we go and look for something that is standard, like, if they're a driver, or if they are a manager of finance, or if they are a director of sales, we go and find an equivalent position. Again, similar company, similar geography, similar size. And we then lay out, here's what you're paying your employees, here's what the data says would be the range of compensation from min to median to max. And then we have 3 different levels of every job. So you can rate someone as minimum, they're at entry level; medium, they're pretty much right in the middle of where this job is; or max, they're maxed out in the job. And then we'll compare their compensation today with the mid, or max, wherever they are rated. And we'll give you then a report that says, here are the people that are flagged as being undercompensated. Here are the people that are flagged as overcompensated. If you're going to adjust this, you probably can't bring the people that are overcompensated down. You're going to have to get them to add skills. The people that are undercompensated, you probably can't get them all up to market rate at once, but here's the plan in order to do it. And here's the kind of money that you're talking about individually and for the company as a whole. And what this does is it gives you the data that you can use then to sit with employees and say, here's your job description, please sign off on it, let's agree to it. It gives you compensation to say to that employee, you are appropriately compensated for the job that you're doing. If you want to make more money, let's talk about how you're going to grow and add value to the company. So it now normalizes the conversation from an employee walking in and saying, hey, I want a raise because somebody just told me I should be making more, to here's a game plan for how you are compensated and should be compensated in the future.
Perfect. That's it.
That's it. There we go. So if you'd like to have if you'd like to have a one-on-one conversation, please use the booking code. Also use the booking code to sign up for Robin's webinar coming up. We'd love to talk to you, especially if you have a question about that benchmark that you just asked about. We can actually show you what one of those reports looks like and how it gets developed, and anything else that you're working on. Make sure you get paid what you're worth. This is really important stuff, and it's what will cause you to say that it is worth sticking around. And if you're getting ready to kind of let go of some of your responsibilities, then make sure that you've got the compensation in place for the people who are going to replace you. Thank you all
Perfect.
for
All
coming.
right. Thank you guys. See you November 5th.